last night, the Fed tweaked the language of its statement to say that it would be patient in beginning to normalize its monetary policy, even as Fed Chief Janet Yellen clarified that the Fed is likely to hold interest rates at least through the first quarter of 2015. What will it take for the Fed to run out of patience, and what does all of this mean for the global economy, but more importantly, global equity markets? Joining us today is Stefan Deo, Global Head of Asset Allocation at UBS. Good afternoon, Stefan. Thank you very much for joining us. What did you make of the change, the minor change in language in the Fed statement? Does this mean that rates will go up or start moving up by mid-2015, which had been the expectation even before we heard from the FOMC last night?
Good afternoon. Yeah, that is our expectation. We think the first rate hike will come in June. As you say, I think it's very much a consensus among economists, but it's not priced by the curve at all. If you look at the forward, they're pricing a few basis points, so very low probability of a rate hike in June. Going back to what you were saying about the message of the Fed, it actually looks very, very similar to what we saw in 2004. The Fed said considerable time 4 times in a row. Then he went to patient twice for 2 meetings. Then he signaled a hike, and then he moved. So the pattern for the time being is extremely similar to 2004, and that's consistent with the first rate hike in the middle of next year, probably June, because there's a press conference.
Okay, so just to do the count publicly, it was in Jan 2004 when they first introduced the word patient in their commentary. They reiterated that in March, and I think they moved rates up in June 2004. So that's 6 months from the first time they used patient and 3 months from the second time that they used patient. That sort of fits in with your estimation of a rate hike in June, right?
That's correct. And again, if you look at what the FOMC is telling us, even Dudley, who's on the dovish side of the FOMC, said a few weeks ago that the central case scenario for him would be a rate hike in the middle of the year. So I think even the dovish side of the FOMC meeting is signaling a rate hike. Say June. Again, you have to keep in mind that they will have to move the Fed funds, but other rate, like the deposit rate. So probably the first move, they will want to have a press conference to explain everything. So June is a very good candidate from my point of view for the first rate hike.
All right. So is this assessment of yours, and this seems to be the consensus assessment, sort of in sync with what went on in the bond markets yesterday? Because we, in fact, did see the 10-year yield move up a wee bit to 2.1%. This even though we got some very negative data on inflation from the U.S., which is another fall of 0.3%.
Yes, the curve has steepened. That is true, but actually I'm checking as we speak. If you look at the Fed Fund contract for June, it does not move at all. So basically, even with this slight tweak in the communication, the curve is still pricing something like 17 basis points. So it basically is saying that rate will not move from where they are right now. So again, you had a steepening. The long part of the curve started to sell off. But what is priced on the short part of the curve is still very, very sanguine. So there is a risk at some point that you have a big movement on the short part of the curve.
Okay, fair enough. I have one more question to do with the Fed situation, so to speak. I'm just curious to know as to what could change this consensus estimate. For instance, if crude prices go from, around between 55 to 60 all the way down to, let's say, 45, which is the worst case scenario that some brokerage reports came out with, do you think that would push out even further a potential hike in interest rates by the Fed?
It's possible, but you have to keep in mind that the Fed has been very, very consistent in saying, A, that they target core inflation, and B, in saying that wage are the main component of core inflation. So even if you see the headline going down because of oil price, they're going to say, well, we don't control oil price, we don't control commodity price. What is really important is the labor market. And as long as you have wage pressure, and we have very clear signs that wages are increasing, not very strongly, but they are increasing, I think the central case scenario has to remain intact. Now, if oil price really fall enormously, as you were
hypothetically putting out,
then obviously top-line inflation would remain low, so you could wait a little bit longer, but not much longer, I think.
All right, Stefan, then the many trillion-dollar question. What does this mean for global fund flows, for global equity markets, especially, from the emerging market point of view? What would it mean for a market like India?
I think a market like India, comparatively speaking, would perform well in EM, but I'm worried in this kind of scenario. You see, if you give me oil price very low or commodity price low, that means that's a negative shock for the income statement of many EM countries. If at the same time interest rates are going up, that's bad news for the same country, which are really leveraged and etc. etc. Again, it's not the case of India. India benefit from lower oil price. But I'm very worried about the income statement and the interest cost for a number of EM countries. They could suffer a lot in this kind of situation because at the same time they have less revenue and more interest payment. So that would be very, very bad for the EM complex in total. Again, India is probably a contra-example in that case.
So would that mean, Stefan, that you're anticipating some kind of defaults? And I'm not just talking about, EM countries like, I don't know if you're looking at Venezuela or Nigeria, but even a big player like Russia, is that something that you're factoring into your assessment over the next quarter or two?
No, I mean, if you look at back of the envelope calculus, the Russian market is now pricing probably a third of probability for a default on the 5-year horizon. I think that's way too excessive.
Okay.
We're going to have a big problem in EM, I think. Some small country heavily exposed to oil could have very severe problem, but we do not think they will go down to default. Russia has a lot of reserves. Russia can balance its budget even with lower price. So I don't think the risk of a default is as high as the market is expecting now.
All right.
It's more a repricing story.
So an emerging market like India, if there is no systemic problem across the global economy, then just stands to gain and make the most of this lower crude oil price situation.
Yeah, the only issue I have with this argument is it sounds correct. It's right. There's a question of contamination. If investors start to run away from EM because there are problems in EM, you could have contamination to other countries. And just to give you one example, if you do a simulation, you will find that some of the countries in EM benefit from lower oil price. That's India, that's Turkey, that's South Africa. All these countries have seen their currency dropping like a stone over the past 1 or 2 weeks. So even those countries who in theory are benefiting, along your argument, which is totally right, even those countries have been very heavily penalized by the market. That's the risk of contamination for the whole EM space. Okay.
Stefan, as Global Head of Asset Allocation, what area do you think would be the best outperforming asset class in 2015? Would it be US equities, US debt? Would it be European equity markets? What would be that one asset class where you're most bullish on from 2015's point of view?
We like equity simply because if the Fed starts to hike rate, obviously everything that is fixed income should suffer. A different reason, but the fixed income space should underperform. So we like equity. Within equity, I think the safe bet is the US. Everybody likes US. I think is a very consensus of weight. We do think that margins in Europe are very low and have a potential to expand. So if you're courageous, if you want to generate alpha, I would advise to go to Europe. But that's obviously a call which is much more risky than the US call.
Okay, one more question from my end. Do you see a possibility of the dollar index hitting 100 in 2015, or do you think that would be stretching it a bit too far?
There's a risk of another adjustment of the dollar because there's a good story for strong dollar. Again, the Fed hiking, the recovery, and etc. There are risks on the downside for all the other currency. The euro would go down because of QE. The yen will go down because of more action from the BOG, and a lot of EM currency, even the one that should strengthen now, are weakening. And I think is due to A, higher interest rate when the Fed will hike, and B, volatility will pick up in this kind of context. As you know, EM currency can go down quite significantly when volatility pick up. So I think your target is a little bit aggressive, but I would not rule it out. I think we are in a strong dollar world, and another adjustment if the Fed becomes a little bit too aggressive is definitely possible. Not a central case scenario, but possible.
Okay, and what would that mean for gold? Because that's also an important point from Indian point of view. What's your call on gold?
We are very sanguine on gold. We think gold is quite expensive for the time being, and it's actually interesting because we had kind of a mini risk-off moment over the past 2 weeks. Gold did not perform very well. So it looks like the safe haven aspect of gold is losing quite a lot, and I think it's simply due to the fact of that the gold price is very, very high. But gold has been a poor hedge for volatility of the recent past.
Stefan, just to go back to your worst-case scenario for the dollar, how would foreign investors in India be viewing what that means for the Indian currency and therefore ongoing flows into India?
Well, typically that's bad, not for India, but for EM as a whole. Very simply, the Pavlovian reaction of investors is when the dollar strengthens is bad EM, and you take your money out of EM. And that's what worries me a little bit with the movement recently. Again, with oil price going down, some country in EM should have seen their currency rallying. Turkey is the good example, South Africa as well, to some extent India. We saw exactly the opposite. So that very much tells you a story about people getting worried about the EM space on aggregate without discriminating within EM. So the risk is that India gets into the average of EM.
And that, you think, could substantively sort of reduce foreign investor flows into the country?
My sense is that the view of foreign investor on India has improved quite dramatically with the new government, with the central bank starting to reduce inflation and etc. That's why India has been one of the darling of the market in EM recently. Obviously, you have to bet that the structural reform will be delivered in the future. But actually, I think India would be less in danger than other countries in this kind of scenario.
All right. We appreciate you speaking with us, Stefan. Thank you very much for those views. Stefan Devder of UBS talking you through the impact of what the Fed did late last night and what his view on equity markets is here on.